for example, if you hold bank accounts or government bonds that are paying you 4%, and yet money supply is growing by 7% per year, your share of the dollar network is shrinking every year. You're just getting slowly diluted over time. Now, of course, you can earn income and offset that, but it's like saving and melting ice cubes. The savings units themselves are getting diluted, and your active income is offsetting that. And so that's obviously something that, as an investor, you want to avoid. If your interest rate is lower than the growth rate of the thing, that's rough.
In a recent interview on Less Noise, More Signal, Lyn Alden delves into the Federal Reserve's influence on Bitcoin, the concept of fiscal dominance, and the critical role of debt monetization. At the time of the discussion, Bitcoin is trading around $67,000, showing a 1% drop in the past 24 hours and a 6% gain over the last 30 days. With the upcoming election and debates over fiscal policy, Lyn explores how the Fed's actions are shaping both traditional and digital assets. Before we dive in, be sure to like, subscribe, and share the channel. Now let's hear more from Lyn Alden.
Probably the biggest part of my macro work has been to analyze the impact of U.S. deficits and arguing that we're kind of exiting this, say, 40-year period of monetary dominance, and then we're entering this period of fiscal dominance. And there's various starting points you can kind of point to. I think 2019 is the part where I would say we kind of entered fiscal dominance, but it really became more apparent in 2020 and thereafter, more visibly explosive in that sense. And basically what that's starting to say is that fiscal deficit in the United States, and of course that has global implications, but fiscal deficit in the United States are larger in a given year than the amount of new bank loan creation, for example. And even in many cases larger than the sum of bank loan creation and net corporate bond issuance. And so in other words, the stock of public debt increases faster than the stock of private debt, at least most of the measurable forms that we can track. Whereas in prior decades, it wasn't even really close outside of maybe a brief recessionary environment. So the fact that that's happening during non-recessions or during periods of low unemployment is relevant. You can look at like a 70-year chart of fiscal deficits as a percentage of GDP and unemployment, and they're very correlated. But ever since around 2017 or so, 2016, 2017, they started to decouple. And there's a variety of reasons for that related to demographics and other issues. But now we're kind of in this more structurally high fiscal deficit environment, and that has a variety of investing implications. It's basically more nominally GDP and inflationary intensive. So I was a big, I argued heavily that inflation was coming starting around 2020, and then it impacted. And then even after that major inflation cycle, is behind us, it still has ongoing ramifications when they're running 6 or 7% GDP deficits during economic expansion with low unemployment and really little room to cut most of those things. And I generally argue that the U.S. has a tougher time than other countries cutting this because they're so financialized. There's like a negative feedback loop where tax receipts in the U.S. are more correlated with asset prices, and especially equity prices, but asset prices in general, more so than many other developed countries. And therefore, attempts at austerity that have any sort of negative impact on the stock market tend to ironically feed back into lower tax receipts and make that austerity and deficit reduction very hard to do. So I think that we're locked in a pretty strong cycle here. So the prior regime was monetary dominance, which is to say that the rate of bank lending and overall private sector debt creation is generally a bigger force in most years on the economy than fiscal deficits, with, again, exceptions for, the year after a recession or during or after. And so monitoring the business cycle and what the Fed's doing and that kind of thing were all very important parts of macro analysis. And what happened starting in the mid-2010s, so starting in like the 2016 period or so, is that the baby boomer generation started to enter their retirement years. And so it's a very large generation in the US and elsewhere. And so retirement systems started to get top heavy at an accelerating rate. That's probably the single biggest variable for like why then did it matter. And that continues. So we continue to have an increasingly top heavy entitlement system where the number of people receiving benefits, whether it's Social Security or Medicare, is very large compared to the number of people paying in compared to ratios of decades ago. So that's number one. Number two is that we had 40 years of rising public debt to GDP. So we kind of bottomed in that metric in like the late 70s or so. We started to rise debt to GDP for about 4 decades, going from 30% of GDP to over 120% GDP. But that was offset by structurally falling interest rates for those 40 years. And really kind of starting in the 2010s, there wasn't really much lower to go. We already went to zero on like the short end, and the long end was at pretty low levels. And you don't really have that offset anymore. And so by the time they started raising rates at the end of that 2010 cycle, and then especially as they've raised rates in the post 2020 environment, that made interest expense actually start to mean something again for the first time in a very long time. And it's when you raise interest rates at a time when public debts are 30% of GDP. So as you go back to the 70s, most of the money creation was happening from bank lending. Deficits were there, but they weren't as big as the amount of money being created from bank lending. And debt to GDP was only 30%. So if you raise rates really high, you slow down that bank lending by a bigger amount than you blow out the deficit. Whereas if you fast forward to the current environment and debt to GDP is 120%, so you have a bigger stock of interest-bearing debt that gets refinanced over time. And if you're in an environment of slower bank lending and larger structural deficits, the source of inflation, or at least the majority source of inflation, is not from excessive bank lending and private sector credit creation. It's from large fiscal deficits that keep pouring into the economy. And so when they raise rates, it does slow down bank lending, but it actually blows out the deficit by an even bigger number than it slows down bank lending. And so inflation becomes stickier, harder to fight, has more consequences when they try to fight it. And some of the tools that we normally associate with inflation, especially in the 70s, either work differently or in some cases work backwards. And Japan would be an example of a country that's even further into fiscal dominance, which is kind of like why they don't even try to raise rates when inflation becomes a problem.
After hearing Lyn Alden discuss the Fed's influence on Bitcoin and fiscal policies, let's take a deeper dive into her insights on debt monetization and its impact on financial markets. Lyn breaks down how these fiscal strategies shape the broader market, particularly affecting investors in the crypto space. Now let's hear more of her analysis.
The first way is to focus on the fact that the baseline for inflation is not zero, it's negative. And that's because generally, thanks to human progress and people iterating on past work and technology getting better, we get more efficient at producing goods and services over time, gradually. And so if you had, say, fixed money, you'd expect prices to go down, not stay flat. And so we're measuring inflation from what is kind of fundamentally a negative baseline. If you used to make shirts by hands, and now you have a big factory that can just churn out shirts really quickly, you'd expect the cost of those shirts to go down dramatically rather than kind of stay the same. So if they're staying the same, which they kind of have been, then you're basically seeing that it's the debasement, the denominator itself is kind of offsetting that. We're having more supply of dollars, whatever currency you can think of, and that's kind of offsetting the structural price declines. So despite the fact that technology makes everything cheaper over time, or most things cheaper over time, outside of wars and other big setbacks of productivity, central banks have positive inflation targets. They want to have prices that go structurally up, despite the fact that technically prices should go down. And so they manage that by encouraging more money creation, either from bank lending or a fiscal deficit that they can monetize. And so to your question of can we grow out of it? Partially you could, if you had something that dramatically reduced the cost of energy and made energy way more abundant. Anything that massively increases productivity, like AI, offshoring and automation were the big productivity enhancers for the past few decades. That's why, for example, most of the inflation shows up in things like hospital services and childcare services and education, things that haven't really been automated that well yet, that actually require a lot of expensive domestic labor. Whereas anything that you can offshore, anything you can automate, ranging from electronics to software to shirts, that's not been very inflationary. In many cases, outright deflationary. And so you have that big mix there. So inflation's a spectrum based on how good we are at, improving it versus that structural background monetary debasement. And then that gets to the second point, which is, I think when it comes to investing, you always want to ask the question, am I being diluted? And if so, how and by how much? And so, for example, the money supply grows faster than CPI, usually. And that's because, again, the baseline for inflation is negative. And so if you have something like 7% annual money supply growth, which is what we've had in the US for about 60 years on average, in developed worlds, generally pretty similar to that number. Emerging world, like developing countries, usually higher than that. So 7% money supply growth. If you have 4% annual productivity growth, you're going to get something like 3% CPI. And it's tricky depending on how you can tweak your basket for how you're measuring CPI. You can tweak around productivity, but basically that's how that gets broken up. And so even if productivity growth is high, and you're keeping up with CPI, you could still get diluted. Meaning that you're not investing as well as you could be, because you could be owning the scarcest, best things that are not diluting you or diluting you very little versus things that are diluting you a lot, but still managing to kind of partially maintain purchasing power. So
To catch the full interview, check out the link in the description. Lyn Alden provides a compelling perspective on the Fed's policy decisions and their impact on digital assets like Bitcoin. We'd love to hear your thoughts. How do you think the Fed's recent actions will impact Bitcoin in the long term? What role might fiscal dominance play in the upcoming economic landscape? If you enjoyed this discussion, please subscribe, like, and share our video for more insights into the innovative world of decentralized technologies.